Have you ever felt like you're always one step behind the market? You buy in when everyone's excited, only to watch it crash. You sell in a panic just before it rebounds. It's frustrating, and you're not alone. Most traders are caught in this exact trap, chasing trends and reacting to headlines. But what if I told you that the real key to success isn't about following the herd, but about understanding the hidden forces that drive these market cycles? What if the biggest opportunities are found where no one else is looking? Today, we're going to unpack a counterintuitive truth that could completely change how you see the markets. We'll expose the critical blind spots that keep most traders from seeing what's really going on. This isn't about some secret formula. It's about a fresh perspective that will help you anticipate market moves instead of just reacting to them. So stick around, because by the end of this video, you'll have an unfair advantage over the rest of the market. Let's start with a common fallacy that traps so many investors: the trend trap. You've heard the saying, the trend is your friend. People see prices going up, get a serious case of FOMO, and jump in, hoping to buy high and sell even higher. This works for a while, during the euphoric phase of a bull market. Everyone feels like a genius. But this strategy is a recipe for disaster when the underlying market psychology inevitably shifts. Think about it. History is littered with examples. The dot-com bubble in the late 90s saw investors throwing money at any company with a "com" in its name, regardless of profits or even a viable business plan. The peak euphoria was insane, but it was immediately followed by a devastating crash that wiped out trillions in value. Or remember the 2008 housing bubble. People believed real estate prices could only go up. Lenders handed out mortgages like candy. When the music stopped, the global financial system nearly collapsed. More recently, we've seen it with crypto. The wild volatility, the massive rallies driven by social media hype, and the subsequent painful corrections. In each case, the pattern is the same. Peak euphoria precedes a significant downturn. And today, with social media, Reddit forums, and 24/7 news, this herd mentality is amplified. It's harder than ever to resist the pull of the crowd, to step back and ask if the price actually makes sense. Chasing euphoria is like playing musical chairs on the Titanic. It's fun for a moment, but you know how it ends. The real pros aren't chasing the party. They're looking for the exit signs before anyone else. So if chasing the highs is a trap, how do you know when the market is about to turn? The answer lies in what I call the silent signals. These are crucial indicators that often appear before a major market shift, but they're usually ignored by mainstream analysis and the cheering crowds. These signals are all about divergences when the price is telling you one thing, but the underlying data is telling you something completely different. Let me give you a concrete example. Imagine a stock's price is hitting new all-time highs. On the surface, everything looks great. But if you look closer, you see that the trading volume on these new highs is getting weaker and weaker. This is a classic divergence. The price is going up, but the conviction, the buying pressure, is drying up. It's a silent signal that the trend is running out of steam. Another powerful divergence is between price and fundamentals. The market might be celebrating, but corporate insiders, the CEOs, and CFOs who know their companies best, are quietly selling off their own shares at a record pace. That's a massive red flag. Or maybe prices are rising while sentiment indicators, which measure investor optimism, are at extreme historic highs. When everyone is bullish, there's often no one left to buy, and the market becomes vulnerable. These silent signals aren't foolproof, but they are incredibly valuable. They are the whispers of the market before the shouting begins. While everyone else is fixated on the price chart, professional traders are watching these divergences closely. They're looking at volume, sentiment, insider activity, and credit market indicators. These are the clues that help them step aside before the stampede for the exits begins. Learning to spot these hidden signals is your first step towards breaking free from the herd and thinking like a pro. Now let's go even deeper. To truly understand market cycles, we need to look beyond the daily noise of supply and demand. We need to understand the cycle's true engine. These are the massive, slow-moving macro forces that create the environment for sustained booms and busts. Three of the most powerful are credit cycles, technological innovation waves, and demographic shifts. First, let's talk about credit. Central banks and financial institutions control the flow of money. When credit is cheap and easy to get, money floods into the economy. This fuels asset bubbles, corporate expansion, and consumer spending. It's the wind in the sails of a bull market. But when central banks start to tighten credit to fight inflation by raising interest rates, For example, the flow of money reverses. It becomes a headwind. Suddenly, debt is more expensive, investment slows down, and asset prices that were inflated by cheap money start to fall. Most major recessions and market crashes are linked to the contraction phase of a credit cycle. It's a force far more powerful than the daily supply and demand for a single stock. Next are technological waves. Think about the invention of the railroad, the automobile, the personal computer, the internet, and now artificial intelligence. Each of these innovations didn't just create a few successful companies. They fundamentally reshaped the entire economy. They created decades-long investment cycles, fueling massive growth and productivity gains. But they also led to speculative manias and subsequent busts, like the dot-com bubble. Understanding where we are in a major technological wave helps you identify the long-term themes that will drive markets for years, not just days. Finally, demographics. The age structure of a population has a profound impact on an economy. A large young workforce entering its prime earning and spending years like the baby boomers in the 80s and 90s creates a massive tailwind for economic growth and consumption. Conversely, an aging population with more people retiring than entering the workforce can lead to slower growth and increased strain on social systems. These are slow-moving trends, but their effects are undeniable. Connecting these fundamental drivers to the current market gives you a roadmap. Instead of just asking, will the market go up tomorrow? You can start asking, where are we in the current credit cycle? What stage of the AI revolution are we in? How will shifting demographics impact consumption over the next decade? These are the questions that lead to real, long-term insight. So, how do you use this knowledge? The goal is to shift from reactive trading to proactive anticipation. It's about developing the power of anticipation by understanding where we are in the broader market cycle, rather than getting lost in the daily noise. This means building a framework for yourself. First, start tracking those macro drivers we just talked about. Pay attention to central bank policies. Are they making credit cheaper or more expensive? Follow major technological trends. Which industries are being created and which are being disrupted? Look at demographic data. Are key consumer groups growing or shrinking? This isn't about predicting the exact top or bottom. That's a fool's game. It's about understanding the direction of the tide. Is it coming in or going out? Second, use this macro view to position your portfolio for the next turn, not the last one. If you recognize that we're in the late stages of a credit-fueled boom, characterized by high valuations and extreme optimism, maybe it's time to reduce risk. You could take some profits, increase your cash position, or rotate into more defensive sectors that hold up better during downturns. Conversely, if you see signs that a bust has run its course, fear is at a maximum, and a new credit or technology cycle is beginning, that's the time to be brave. That's when you start deploying capital and positioning for the next major bull market. This approach requires patience. It means you might look foolish for a while. You might sell too early while the party is still going, or buy too early while prices are still falling. But over the long run, this strategic positioning is what separates successful investors from those who are perpetually whipsawed by the market as emotional swings. You're not trying to catch every little wave. You're positioning yourself to ride the big, powerful currents that truly matter. Stop chasing past performance and start anticipating future shifts. Let's bring it all together. The counterintuitive truth about market cycles is this: true, lasting opportunity is not found in chasing trends with the crowd. It's found in understanding the underlying forces that consistently confound the crowd's expectations. Your unfair advantage comes from seeing what others miss. We've talked about the trend trap and why chasing euphoria is a losing game. We've uncovered the silent signals, the divergences that warn of a coming turn. We've delved into the cycle's true engines, credit, technology, and demographics, that shape the economic landscape. And we've discussed how to use this knowledge to shift from reacting to anticipating. This is a challenge to you to rethink your entire approach. Stop letting fear and greed, amplified by social media and headlines, drive your decisions. Start building a framework based on these deeper, cyclical forces. Empower yourself with this knowledge. Look for the blind spots in the mainstream narrative. Ask the questions that no one else is asking. This is how you stop being a passenger on the market roller coaster and start becoming the navigator of your own financial journey. By seeing the market for what it truly is, a series of repeating cycles driven by human psychology and fundamental macro forces, you can position yourself for long-term success. Thanks for watching. If you found this perspective valuable, hit that like button and subscribe for more content that challenges conventional wisdom. Let me know in the comments what you think. What cycle are we in right now? See you in the next video.